KPop Netflix hunters. Can it bounce back this week? The market thinks Netflix is singing the blues, but the company has a more uptempo soundtrack in mind. The market wasn't impressed by Netflix, NFLX owned 70%, after the company kicked off earnings season for streaming services stocks last week. The overall market may have rallied to fresh highs, but Netflix stock plummeted 12% as it sank lower in each of the week's last 3 trading days. Like KPop Demon Hunters, the animated feature with a catchy soundtrack that remains one of the platform's most viewed movies over the past 4 months, Netflix has some demons to vanquish. And like the main protagonist, Netflix is conflicted in the fight. Below, I'll take a closer look at last week's report and what seems like an unfair market response. If I'm right, the recovery this week and beyond is going to be golden. The big picture is a moving picture. Last week was challenging for the pioneer and market leader for premium streaming services as it posted disappointing third-quarter results after Tuesday's market close. Revenue rose 17.2% to $11.51 billion, a smidgen shy of the 17.3% leap that it was forecasting 3 months earlier. The bottom line was a bigger miss, as net income rose 9% to $5.87 a share for the 3 months ending in September. The company was modeling its per-share earnings to jump 27% for the period. Zooming in, the headline earnings miss is jarring but not a long-term concern. Netflix points out that one-time hits related to a tax dispute in Brazil were behind the shortfall on the bottom line. If not for those expenses, the company's margin and results would have gone roughly according to plan. The top-line results are naturally still pretty good. This is the first time in more than 4 years that Netflix revenue clocked in with growth north of 17%. Now let's zoom out. I'm not just talking about the stock itself, which continues to do just fine for most Netflix investors who didn't initiate a position last week. Even after its post-earnings pullback, Netflix stock is beating the market with a 46% gain over the past year and has nearly quadrupled over the past 3 years. I won't even brag about my own returns as a Netflix investor, since I purchased shares when it was a broken initial public offering, IPO, in 2002. Zoom out just enough to look ahead, something that every investor should do, and the bullish thesis still holds up. Netflix guidance is solid. It sees another quarter of roughly 17% year-over-year growth in revenue, and net income should soar 28% for the seasonally sleepy fourth quarter. I want to start with a negative trend that has emerged over the past 5 quarterly reports. I'll go over the market's reaction to the stock the day after it offered its results after the previous day's market close. This isn't just the second time that the stock behaved badly on earnings day. The market's reaction has deteriorated with every passing quarter over the past year. It's no longer just an anomaly, something that I was hoping was the case with the prior quarter's dip. It's not good, but I still see last week's pullback as a buying opportunity. The platform is too sticky and scalable to fail at this point, and has the largest premium audience paying rates that go higher on a regular basis. Its closest rival just raised prices last week, but Netflix hasn't bumped its subscriptions higher since January. It should happen soon, and that will send Wall Street pro targets higher. It's also been a decade since Netflix declared a stock split, but that could change the next time the shares start to rally at current levels. Stock splits are zero-sum games but have a funny way of showing off confidence and attracting retail investors with the misconception that a stock with a larger price is overvalued. About that, Netflix is conventionally overvalued, trading for 34 times forward earnings, half of its current revenue growth, and still greater than its better bottom-line increases. Isn't going to woo value investors. However, a lot of folks who have missed Netflix as a wealth-altering growth stock have overlooked its dominant position and how that will make it hold up better than other platforms in a recession or a media stock services shakeout. Netflix can do a lot with its almost $9 billion in free cash flow over the trailing 12 months. Finally, give KPop Demon Hunters a chance. It's better than you probably think. And the same also applies to Netflix stock after last week's sell-off. Should you buy stock in Netflix right now? Before you buy stock in Netflix, consider this. The Motley Fool Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy now. And Netflix wasn't one of them. The 10 stocks that made the cut could produce monster returns in the coming years. Consider when Netflix made this list on December 17, 2004. If you invested $1,000 at the time of our recommendation, you'd have $590,357 asterisk, or when Nvidia made this list on April 15, 2005. If you invested $1,000 at the time of our recommendation, you'd have $1,141,748 asterisk. Now, it's worth noting StockAdvisor's total average return is 1,033%, a market-crushing outperformance compared to 193% for the S&P 500. Don't miss out on the latest top 10 list, available when you join StockAdvisor.